Welcome to the deep dive.
Yeah.
Today, we're jumping into budgeting, a really core thing for any organization. We've got some great source material walking us through the whole process, from planning right through to the final reports.
Yeah, it covers the whole life cycle.
And our mission here, to break it down, make it clear how budgeting works, why it matters, without getting, lost in the weeds.
Sounds good. Let's do it.
Okay, so where do we start? This idea of operational and tactical planning.
Right. So think of the budget itself as a tactical plan. It's single-use, focused, pretty short-term, usually about a year, maybe 18 months max.
And the annual budget is the main tool.
Exactly. That's how the big strategic plans, the 5-year visions, get translated into, well, an operational guide for the next year.
And it seems key that managers get assigned responsibility for parts of it.
Absolutely crucial. When you assign that responsibility, achieving those strategic goals becomes more routine. It's embedded in their work.
So it's not just finance looking at numbers, it's linking strategy to action across the board.
Precisely. It's the operational engine for your strategy.
Okay, but to make that work, you need rules, right? Policies?
Yes. Formal budget policies are really important for keeping it structured.
Makes sense.
You often have things like budget committees, managers getting together to, hash out the details.
But the overall direction, that comes from higher up.
Yeah, top management usually provides the guidelines based on the strategy, obviously, but also what's happening right now, market conditions, the economy.
Got it. And these budgets often use standards. What are those exactly?
Think of standards as like per unit budgets, targets for cost or usage.
And there are different types.
Right. You've got ideal standards aiming for absolute perfection, no waste, no downtime.
Sounds tough. Motivating or demoralizing?
Can be both. Pushes improvement but might feel impossible. Then there are currently attainable standards.
More realistic.
Yeah, they factor in normal spoilage, a bit of downtime, efficient but achievable. The downside needs judgment, could maybe be manipulated.
And who sets them? Management just dictates.
That's one way authoritative standards. Quick, includes everything. But workers might resist if they have no say.
So the alternative is?
Participative standards. Managers and the people actually doing the work set them together. Takes longer, but you get better buy-in.
Okay, so all these pieces, the planning, the standards, they feed into something bigger, the master budget.
Exactly. The master budget, it's basically the annual business plan, all documented. It sets out the short-term goals for the year.
Combining the operational side and the financial side.
Yep. Operating budgets like sales, production and financial budgets, cash flow, projected statements. It's meant to be comprehensive, coordinated, all aligned with the strategy.
Sometimes called a static budget.
That's another name for it. Static profit plan, targeting budget. But yeah, a key limitation is it's usually for 1 year at one expected level of activity.
So those pro forma statements might not tell the whole story if things change.
Right. Useful, but maybe not for every single decision.
Okay, walk us through the mechanics. What's the absolute starting point?
Sales budget. No question. It forecasts your sales units and dollars.
And that drives everything else.
Pretty much. Production, materials, labor. It all flows from what you think you'll sell.
Where does that forecast come from? Crystal ball.
Well, maybe a bit of that, but mostly it's sales team input, statistical analysis, management opinion. You look at past sales, economic forecasts, competitors, pricing changes, market research, ad plans, a whole mix of factors.
Makes sense. So sales forecast is done. What's next?
Production budget. Based on sales, how many units do we actually need to make?
And there's a formula.
Simple one.
Yeah.
Budgeted sales plus the ending inventory you want minus the beginning inventory you already have.
Okay.
That equals budgeted production. You might add a safety stock buffer in there too.
Okay, production plan leads to
Materials. Direct materials budget. Yeah. 2 parts really. How much material do you need to use for production and how much do you need to purchase, which includes building up inventory.
Got it. And then labor.
Direct labor budget. How many hours will production take and what's the labor rate? Multiply it out for total wages.
And the other factory costs.
Factory overhead budget. That covers everything else in production, indirect materials, indirect labor, depreciation on equipment, utilities, often applied based on, say, direct labor hours.
And all that production cost detail flows into?
The cost of goods manufactured and sold, budget. Totals up materials, labor, overhead to figure out the cost of the stuff you made and the cost of the stuff you sold. That feeds right into the projected income statement.
Okay, that covers production. What about non-production costs?
That's the selling and administrative, or S&A, expense budget. Covers things like sales commissions, advertising, office salaries, rent. Some are variable, tied to sales, some are fixed.
And these are period costs, right? Not part of the product cost.
Correct. They hit the income statement in the period they happen.
Now, a really critical one, cash.
Oh, absolutely. The cash budget, super important. It projects your cash inflows, primarily collections from customers, and your outflows, paying suppliers, employees, operating expenses.
Broken down, usually.
Yeah, typically sections for cash available, starting balance plus collections, cash disbursements, payments, and then a financing section showing any borrowing needed or repayments planned.
Vital for just keeping the lights on and managing liquidity.
Totally. Avoid surprises, plan for loans if needed.
And all these budgets eventually let you create the big financial summaries.
Yeah, the pro forma financial statements. Projected income statement, balance sheet, statement of cash flows. They pull together the results of all the operating and cash budgets.
Gives you that future snapshot. One more thing, flexible budgeting. How's that different from the static master budget?
Good point. A flexible budget isn't fixed at one activity level. It adjusts. It says, okay, if we actually produce or sell this much, what should our revenues and costs look like?
So it uses per unit revenues, variable costs per unit, and fixed costs.
Exactly. Within a relevant range, of course. Its power is comparing actual results to what should have happened at the actual volume. Helps spot efficiencies or waste.
But it depends on getting those fixed and variable cost distinctions right.
Absolutely. And knowing the relevant range where those assumptions hold true, get that wrong, and the flexible budget isn't so useful.
So, wrapping up, budgeting is this really interconnected process. It takes strategy and makes it operational. Guides resources, measures performance. It's much more than just bean counting.
Definitely. It's a core management tool.
Okay, here's a final thought for you listening. Business is dynamic, always changing. So how can companies make sure their budget isn't just this rigid once-a-year thing? How do you keep it agile, responsive to what's actually happening? What's the role for maybe these more flexible approaches in really driving long-term success? Something to mull over.
Great point. Food for thought.
Thanks for diving deep with us today.